forget to do that. So on Monday, we'll talk about test review together, and then we'll get a little, some practice with a few of them. And then on Wednesday will be our exam. Okay. Is that good with everybody? Yeah. All right. And so today, so our problem on the test, we've got 20 multiple choice and 1 problem. And the problem on the test, hi, Miss Katie. Hi there. And the problem on the test is the pension worksheet that we've been getting practice with. And so the problem, and we're going to do another one of them together on Monday, but the problem on the test is the basic pension worksheet. So there are no, there is no other comprehensive income for prior service cost. There is no other comprehensive income for gains or losses, right? So it's a basic pension worksheet like the ones we've been getting practice with, right? But today I have one picked out for us that's a 3-year worksheet, and it has everything. So it has the prior service cost, it has gains and losses. So it has everything that we can kind of get practice with, but just know that the pension worksheet on the test is the basic pension worksheet that we got practice with, Monday, Wednesday. So that's actually the problem on the test, just a basic one. But today I thought we could get practice with a little bit more comprehensive one. So we're looking at problem 20-3. And so we're on page, and I've got my book pulled up here. It starts on page 1169, and then it goes on to page 1170. And so it's problem 20-2. What did I hope I didn't say 20-3. Problem 20-2 is what we're working on. And again, it's a 3-year worksheet. So we're going to get a lot of practice with what we do with, these different things. And we've been getting practice with it all week. So hopefully making sense. But I'm going to share my screen with you and get the Excel spreadsheet pulled up. And so I'm just using the same Excel spreadsheet that we've been using all week. And I'm just going to I'm going to fill in the first year on this one, and then actually, I'll go ahead and do it now. We'll just, hot dog. I'll just copy and paste. So then we can do the next year's worksheet, because it's going to be 3 years all together. So copy this. And so, yeah, this is a nice comprehensive problem for us to do, right? 3 years worth of information. So, okay. So problem 20-2. It says Jackson Company adopts acceptable accounting for its defined benefit pension plan on January 1, 2016, with the following beginning balances. So plan assets are 200,000. All right, so I'm going to go ahead and just type this in as they're giving it to us. So beginning balance, and this is as of January 1. So beginning balance, January 1, 2016, we've got plan assets of 200,000. And let me get this all changed to currency. So hot dog. So it's showing us the dollar signs and all that jazz. Let's see where we at. Currency, we don't need any decimal places. I'm going to change it where it looks like that. So, okay. So we've got plan assets of 200,000 and a projected benefit obligation of 250,000, right? So obviously, as we've already looked at, as we've already practiced, if we've got the projected benefit obligation of 250, and I'm going to try to blow this up a little bit more so we can see it a little bit better. But if we've got the projected benefit obligation of 250, and we've only got plan assets of 200,000, then we have a liability here, right? Basically a $50,000 liability. So 250,000 minus 200,000, we've got a liability at that point of 50,000, right? Because our projected obligation is 250, and we only have plan assets of 200. So that's a pension liability at that point of 50,000, right? Those are our beginning balances rather. And then on the next page, it says other data relating to 3 years operations of the plan are as follows. Okay, so now it's giving us, so this is beginning balance January, and actually let me even be a little bit more specific, January 2016, right? And so now for 2016, okay, it tells us we've got annual service cost, and I'm just going to type them in here in the order that it gives it to us. So annual service cost. Remember, the service cost increases our pension asset, or our pension expense rather, increases our projected benefit obligation. So service cost 16,000, that increases our pension expense, that also increases our projected benefit obligation, right? Okay, again, we've gotten practice with that. We know the service cost, how to handle that. So the settlement rate and the expected rate of return are both 10%. So remember, the settlement rate is 10% of the projected benefit obligation. So settlement rate 10%. And again, that settlement rate is 10% of our projected benefit obligation, right? So the interest cost equals 250,000 times 10%, 0.10. So that's our settlement rate. That's an increase to the pension expense. That's an increase to the projected benefit obligation, is how we handle that. Again, I'm just going right in the order of they're giving us the data in the book. So the next one they give us is we've got actual return on plant asset, okay? Actual return. And what does it say? We've got an actual return of 18,000. So that is a negative to the expense, because this is money that we had a return. Basically, we earned interest or we earned dividends on our plan assets. So that's a negative to the expense. That's an increase to the plan assets, is how we handle that one. And then let's see. So we've got on this one now, okay, because we have actual
Miss Mannion.
Go ahead.
Which, we're on problem 20-3?
20-2.
Oh, okay.
20-2. I'm sorry, Jake. I'm sorry.
Thank you. You're good. I was like, where's this numbers? Okay. Thank you.
Yeah, 20-2. And so also what we have to look at, because now this is going to be the first one that we're getting practice with the gains and losses, right? And so the gain or loss on it at this point is the difference between the actual return and the expected return, right? So the expected return, and I'm just gonna type this, or maybe, well, yeah, I guess I'll just type it over here. So expected return is the plan assets 200,000 times the expected rate of return, which is 10%. Okay, so the expected return equals 200,000 times 0.10. So our expected return is 20,000, right? That's what we expected to have. And we had an actual return of 18,000. So we've got a $2,000 loss that we have to recognize. And so when we have a difference in some of these, and in fact, all of them up to this point, our expected return has been the exact same as our actual return. So we haven't had a gain or a loss, right? But this is our first one now where again, our expected return is 20,000, but our actual return was only 18. So we have a loss, an unexpected loss. And so that's what we're going to have here, unexpected loss. And then I'm just going to put in parentheses that this is the difference between actual and expected return. Uh-oh, if I could type here. Oh, hot dog. Right, so expected loss, the difference between the actual and expected return. And so we should have had 20,000 expected return. That's what we expected. We only had 18. So we need to subtract another 2,000 here. That loss decreases our pension expense. And then again, we haven't used this column yet. We haven't had gains or losses yet, but this is where we'd have this other comprehensive gain and loss, right? Now we're in this column, other comprehensive gain and loss. And so this is a debit to other comprehensive gain and loss. So that increases other comprehensive income because it's a loss, right? Remember, other comprehensive income, when there's a loss, we're increasing it with the debit. Or I guess you could say, you know, other comprehensive income is going up because we have that loss. And then if it was a gain, we would be like it would be a negative number. It would be a credit as opposed to a debit, right? And I think in the following years, we do have a gain that we get to get practice with. But that's how we handle that difference between the actual return and expected return. And in this case, it being a loss, right? Because we expected 20,000, we had actual return of 18, right? The next thing that they give us, contributions. So we've got contributions. And so we have contributions in 2016 of 16,000. Remember, contributions decrease our cash because that's money we're contributing to the plan. So it decreases our cash. It increases plan assets. All right. What else do we have here? Benefits paid is our next number that they give us. Benefits paid. And remember, the benefits paid are paid by the plan administrator. So benefits paid decrease the projected benefit obligation. And what did we pay out in benefits? 14,000. So they decrease the projected benefit obligation, decrease the plan assets. Is how we handle the benefits there, right? And I think that's the last thing that we have to put here for our journal entry. So we can total up our columns. And let's see here. So if we do it just right here, our journal entry, total these up, equals the sum, and I'll just grab all of them here. Pull it along. Okay, and then just like we did in class, kind of get rid of these zeros that we have there. All right, and then I'm going to put a line so we know that this is, we've calculated these, right? So this is our journal entry. And then it does tell us in the problem that we had some beginning balances as well. You know, those don't necessarily figure into our journal entry. But one thing that we do have to do to get the full amount is, remember, now we're looking at, okay, we've got projected benefit obligation of 277,000, right? We've got this plan assets of 220,000. So what should be our liability right now? We started with a $50,000 liability, essentially, right? But now, looking at the difference between these two, our liability should be 57,000. So we need another credit here. So we're going to say equals, we already have the 50,000 in there. So let's see, because we want to say, what's the best way to put this formula in here? Because we need another 7,000 basically. So let's do this. Let's say equals 277,000 minus 220 minus the 50 that's already in there, basically. So again, we need to recognize more of a liability, right? Because we've got 277. Oh man, I'm trying to get my pen out of here so I can write this on here. Because we've got 277,000 projected benefit obligation. We've got 220,000 plan assets. So we need a liability of 57. We already had the liability of 50. So then we just need to basically credit that additional credit for 7,000. So that's where I got the 277 minus the 220 minus the 50 that's already there. Oh, hot dog, what's it doing to us? Jake, this is what kept happening to you in class, huh? Kept being funky to us. Okay, let's try it this way. 277 minus 220. Make sure I got enough zeros. Minus the 50,000 we already had there. 7,000. There we go. And so here's our journal entry. And actually, we need this 7,000 for our journal entry. Darn it, not the 57. Oh, let's see here. So equals 277,000. I'll get this right eventually. Minus 220,000. Oh, that's too many zeros. Minus 50,000 that we already have in there. There's our journal entry. And so that makes this equals the 50,000 we had in there, plus we're going to credit it for an additional 7. That takes it to the 57. That one I guess I should have added another line between there, but either way, this is our journal entry, right? And so the journal entry for this first year, we'd have debit, pension expense, right? Because here are our columns up here. So debit, pension expense. Debit, pension expense. For 21,000. We want to debit other comprehensive income. For this loss, 2,000. Let me go down a little bit. Okay, so those are our debits, right? So this is a debit to the pension expense. Expenses increase with the debit. This is a debit for the loss, right? Because other comprehensive income, we debit it when there's a loss. And then we're going to credit cash for the amount that we've spent in cash, 16,000. We're going to credit pension liability. Oh man, I keep going to the wrong one. Pension liability for the 7,000. So that would be our journal entry for the end of 2016, right? That would be December 2016 entry. All right. How are we doing with that so far? Is that looking okay? So we could go ahead. We did our journal entry And so these accounts that the balance will go on is that we need the total. We're going to carry this balance. Oops. We're going to carry this balance down. Oh, geez, Louise. We're going to carry this balance down. We're going to carry down the 57,000 to the next worksheet. And then we're carrying down each one of these. Projected benefit obligation, plan asset. So those are the numbers that are going to carry down to now year 2. For pension, we're going to have all new pension expenses. We're going to have different cash, right? But now we're carrying down those permanent accounts. And so beginning of the year, January 1, 2017 now is where we're at. January 1, 2017. Right, so we had this balance here in other comprehensive income. We had the balance in pension asset liability. And then we had the balance in projected benefit obligation. We had the balance in plan assets. Okay, so those are the balances that carry forward from 2016. So now we can go through and deal with the information that they give us for 2017. So 2017, so it tells us, and this is, again, we're looking at the top of page 1170. It tells us that we had a prior service cost. The plan was amended 1/1/2017. Hopefully we all see that in 2017 for 160,000. So we had that prior service cost. And remember, that's when we're saying, okay, we want to increase our projected benefit obligation. We want to increase our defined benefit plan. And so we're amending the plan 160,000. So remember, when we do this plan amendment, we're going to say additional prior service cost. And I cannot type today, service cost. And so that, remember, we don't expense this whole thing at one time, right? We charge it to other comprehensive income. We amortize it over time. So this is going to be 160,000 other comprehensive income. We're going to be increasing other comprehensive income 160,000. This also increases our projected benefit obligation 160,000. Okay, so remember, it goes to other comprehensive income because we're not expensing the whole thing. We're only going to expense a portion of it. We're only going to amortize a portion of it. Okay, so that prior service cost, that was the first thing that we needed to deal with on that worksheet. And so now this projected benefit obligation, remember when we've got that additional prior service cost that we add on, that increases that projected benefit obligation. So all of our numbers now are going to be based on the 277,000 we had in there to begin with, plus the additional prior service cost that we just added. So now the balance in there is $437. Let me see if I could blow this up a little bit more. I zoomed out and then I forgot to blow it up a little bit more. Okay, so we dealt with that. So now let's look at the other information that we kind of just have on an annual basis. So we can list our service cost for 2017. I don't know, I can't get it right. Service cost for 2017. They're telling us in the book, our service cost is 19,000. That increases our pension expense. That increases our projected benefit obligation. I keep having to cover up the 2016 numbers. Let's see, what's the next thing that we got here? The settlement rate. Settlement rate. And remember, the settlement rate is 10%. And it's 10% of our projected benefit obligation. So 10% of that 437,000. So this equals 437,000 times 0.10. Settlement rate 43,700. And again, that increases our pension expense. That increases our projected benefit obligation. All right, now we've got actual return on plan assets, 22,000. Actual return. When we have that return, that decreases pension expense, that increases our plan assets. That's, whatever interest or dividends that we earned on our investment. I just realized I don't have these formatted where it's showing us the stuff. Hot dog. You don't need decimal places though. All right, so we've got our actual return. Now, what was our expected return? Remember, expected return is, basically 220,000 times 10%, right? So expected return equals 220,000 times 10%. So now we see in this case, our expected return is the same as our actual return, right? Our expected return was the same as our actual return. So we do not have to recognize any additional loss. We do not have to recognize any gain on this because our expected return was the same as actual return. So we don't have that, that unexpected loss that we had in year one. Okay, so now the next thing we're looking at that they give us is what? So we've got actual return, annual funding, so the contributions. And we had contributions of, let's see here, 40,000. So that decreases cash. So we're gonna have, and how did I put this? Did I put it up there as a, yeah, I put it as a negative. Okay, I just want to make sure I'm doing it the same way. So this decreases cash. So we're gonna have that negative to cash. And then the contributions decrease our projected benefit obligation. Okay, contributions, benefits paid is the next line that they're showing us. And I'm just going in the order that they're giving it to us. So remember, the benefits are paid through the plan administrator. So that doesn't affect our journal entry, but any benefits paid, which in 2017 were 16,400, they decrease the projected benefit obligation. They decrease the plan assets when benefits are paid. We already dealt with that prior service cost. So then we have amortization of the prior service cost. Amortization. Now this is the portion that we're expensing. So again, we've got overall this prior service cost of 160,000, but for this year, we're amortizing how much? What does it tell us? Prior service cost. Amortization of prior service cost, 54,400. So this increases our pension expense. This decreases our other comprehensive income. So minus 54,400 because we've amortized some of that now. Okay. So now let's look at our totals. So that was the last thing that we had for this year, that amortization of the prior service cost. Again, that prior service cost is 160,000, but we're amortizing 54,400, right? All right, let's come up with some totals here and see where we're at, because we still need to adjust this pension asset liability column, but let's see how much we need to adjust it. I'm going to do some totals here. So equals the sum of all of these. Okay. Delete these zeros out of here that we don't need. Okay. And so now, what are we? Yeah, we've still got, we got the 22 there. We got the, oh, you know what? I forgot. Where is my, okay, no contributions. Oh, you know what I did? I forgot to do, guys. I did this on the wrong side. So contributions, that does decrease cash, but it increases our plan assets because we're putting that money into our plan assets. So I'd like to say that I did that on purpose, but unfortunately I did not. Okay, so now we're looking at, we've got what? So we've got the 19,000, we've got the 43,700. I feel like this is, what is this calculating here? Oh, you know what? It's adding in the 437,000 twice is why this number looks so funky. So let me re-put this in. So equals the sum of from down here, because remember that 437,000 we already added in basically. We already added those together. So going up back to the two, it was double adding the 437 basically is why that looked so big. But we've still got a big liability here. You know, again, we can see we've got projected benefit obligation of 483,300. Well, we've got plan assets of 265,600. So we need an additional liability here. So just like we did before, we'll say 483,300. That's our projected benefit obligation minus 265,600. And then minus what we already started with. We already had 57,000 obligation in there. So essentially we need an additional 160,700 in our obligation. And I don't know why I keep messing this up here. Put it there. That looks better. Okay. All right, because then we've got all of our journal entry numbers on one line, right? Because remember, this is our journal entry, right? Oh, hot dog. Oh, geez. Okay, so this is our journal entry. Highlight this for us. Right, here's our journal entry. Okay, so for our journal entry for this one, we are debiting pension expense 95,100. We know we got to credit cash. We are also decreasing because what we had, so we need to debit other comprehensive income for the difference here. So debit OCI for the prior service cost. Debit OCI for the PSC, prior service cost. And so the amount is going to be the difference between 160,000 plus the 54, which again is the 105,600, right? And actually, it makes me think about this 2,000, because we already had that 2,000 loss in there. And so we had already debited that. So what, just double checking to make sure that I put it in here right. Because I'm thinking we have to do something with that. We already have that loss. We're not changing the loss. Let's see here. So we've got in other comprehensive income, 103. Right, so we have to add it back to it because it should, well, 105, or no, I guess there's not any changes to it. So debit, other comprehensive income, 105,600, debit, pension expense, okay. All right, we have it on there, right? Credit, cash for 40,000. Credit, credit, pension liability for 160,700. And I'm just,
Yeah, the debits equal the credits there, so.
Yeah, they do. Okay. That's what I was double checking, Jake. I don't trust myself. Okay. All right. So that's the second year. So, again, this is a very involved, this is a comprehensive pension worksheet, right? Your pension worksheet on the exam, it's only 1 year, number one. And plus it's similar. It's more like the ones that we did together Monday and Wednesday in that it doesn't have, or Monday, really, it doesn't have that prior service cost. It doesn't have that gain or loss, but nonetheless. Okay, so our balances that are transferring down, we're still going to have this 105,600 in other comprehensive income from the prior service cost. We're still going to have this 2,000 from the loss. Now we're going to have 217,700 from the pension liability. We've still got 483,300 for the projected benefit obligation. We've still got 265,600 for the plan assets. So those are now the numbers that are going to carry down to our next year, right? And so I am going to go ahead and plug these in. So this would have been what, December 17 entry. So now we've got January 1 of 18 beginning balances. And so we've got this beginning balance in other comprehensive income. We've got the beginning balance in the gain and loss. We've got the beginning balance in the pension asset liability. We've got the beginning balance in the projected benefit obligation. We've got the beginning balance in the plan assets. All right, so we've got our beginning numbers in there. I am going to just change all of this to currency, so it gives us our dollar signs and our commas and everything. Okay, so now we can go through and we can start looking at all of our information for this year, for 2018, right? Now we're on 2018. So 2018, we had annual service costs. So we've got our, and I'll just go one line down, it doesn't matter. Service cost. Remember, service cost increases our pension expense, increases our projected benefit obligation. So we've got annual service cost, 26,000 increase to the expense, 26,000 increase to the projected benefit obligation. What else do we got here? Settlement rate is the next thing they give us. Settlement rate. And remember that settlement rate is 10% of that projected benefit obligation. So settlement rate equals projected benefit obligation times 10%. So that settlement rate increases our pension expense, increases our projected benefit obligation. All right, what do we have in here next? I'm just looking at our book and what they're giving us next here. So then we've got actual return. Okay, so, you know, again, this is where we're going to have to look at actual return versus expected return, right? So let's see here. We had actual return of 24,000. What? 24,000 even. So actual return 24,000. So remember, returns decrease our pension expense. 24,000. Increase our plan assets. 24,000. That would have been interest or dividends earned on our plan assets. But let's look at what we expected. Let's look at our expected return, because remember, any gain or loss is the difference between the actual return and expected return. So expected return equals 265,600 times 10%. So expected return was 26,560. And again, we had actual return of 24,000. The difference between those two is our unexpected loss. So we've got unexpected loss. And I'm just going to say this equals our 26560, our expected return, minus our actual return. And I'll just put that in parentheses here. Difference between expected and actual return. Okay, so, and this should be a negative, actually, darn it. Make that a negative. Oh no, hold on, what did I do? 25, there we go. Because again, just like the actual returns decrease our pension expense, any losses that we claim are decreasing our pension expenses as well, increasing other comprehensive income for gains and losses is what that one would look like. So now that account's going to be up since we're increasing that now. Okay, what else are we dealing with here? So we've got actual returns. Okay, the next thing they give us are contributions. Contributions. We've got contributions of 48,000. So that decreases our cash. Increases our plan assets. Those contributions. What else do they give us next? Benefits paid. I'm just going right in order of how they give them to us. Remember, the benefits are paid through the plan administrator. So that just decreases the obligation and the asset. So benefits paid out 21,000. So minus 21,000 here, minus 21,000 there. All right, what's the next thing they give us? Amortization of prior service cost. Amortization of prior service cost. And so that amortization, they tell us 41,600. That increases our pension expense. Amortization of prior service cost decreases the other comprehensive income. Since we've amortized some of it now, it's going to decrease that other comprehensive income. What else do we have here? It looks like that is the last thing that they're telling us. Now they're also saying here, change in actuarial assumption establishes a December 31st projected benefit obligation of 520,000. So essentially what we want is we want this projected benefit obligation now to be 520,000. So right now it's at, let's see if we highlight these. Right now it's at a sum of 536,600. And so we want this to be 520,000. We want to reduce this. And so that's good. That works in our favor. That means our pension liability is going to decrease, right? And then that's also going to offset losses, right? Because now basically we're recognizing a gain because we had an obligation of 536,630. And now the obligation has been reduced down to 520,000. So now we've got a gain that we have to recognize. So this is a liability, a gain on the liability, or a liability gain, because our liability is going to decrease, essentially is what's happening, right? So the amount that it's going to decrease by, we can say, okay, equals, trying to think of the best way to put this in here. Maybe what I'll do is I'll total these columns up first. So I know we're running a little bit behind. If you guys have to get off and get to another class, that's okay, but we're almost done with this, so I'm going to get it finished here. Equals the sum of these guys together. And then we summed up that. Okay. And so now we can say, all right, our gain, oh Lord have mercy, gain on liability equals what, 520,000 minus 536,630. Because again, we want there to be 520,000 in there. We're trying to get a negative number here because it's a gain. So it's going to reduce that other comprehensive income. And then also we need to calculate the difference between these two now. So remember the pension liability was 217,700. Now it has decreased because our projected benefit obligation is going to decrease as well. So now we have to, and this also, so this gain on the liability, this is going to decrease other comprehensive income. This is going to decrease projected benefit obligation. And then we need the difference between these two in this liability account. So equals, and I'm just trying to think because we want to decrease or debit the liability for the difference. So let's say, just like we've been doing, 5, well, and actually, let's see here, because we've got the 1630 in there already. Yeah, so let's do, I guess let's total these up again. Lord have mercy. Equals 536,630 plus the decrease that we had to the obligation. This still equals 316,600. Okay, now we've got our accurate numbers. We can calculate what the difference in the liability is. So equals 520,000 minus 316,600 minus the 217,700 we already had in there. So 14,300 is what we want to debit the liability for. So now we've got all of our totals in here correctly. So now this is our journal entry. Journal entry equals the sum of all of these. Okay, that's going to be the same for cash, for other comprehensive income. So we've totaled up those columns. Okay, this is our journal entry. Well, hopefully it equals. Oh gosh, okay, hold on. We just got to do our last journal entry and we're done with this thing. Okay, so we're debiting pension expense. Right, debiting pension expense for 89,370. So that's our pension expense. Now, remember, we also have a debit to the liability over here because that liability decreased. So debit pension liability, 14,300. And actually, just for my own sake, so I know we've got this. We did that one. We did this one. Okay. Other comprehensive income. So other comprehensive income had a debit balance. And now because we had some, we amortized some of it, we had some gains. Now we need to credit other comprehensive income. Credit, I'm just gonna abbreviate it, other comprehensive income for the gain / loss. And so that's the difference between, what do we have? You know what we didn't do is we don't have this, somehow, I guess this didn't add in the total from here. So let's see here, 14,000. That's weird how that is coming up here. So 14,000. It's showing 14,700 on this gain. I know it has something to do because the gain was 1630. That's what that unexpected in there already. Okay, well here I'll put it in here like it's showing us. So 14,070, and then credit OCI for prior service cost. And we've got 41,600 there. And then credit cash. And I meant to tab these over a bit, but credit cash, 48,000. Okay. I'm sorry, guys. We kind of got rushed. It looks like I highlighted the wrong numbers here, but that's what our journal entry would look like. I apologize for running over time. I just wanted us to get some practice with this worksheet. This was a really comprehensive worksheet because we went through 3 years, but nonetheless, it got us a little bit more practice. And again, when we do test review together on Monday, we'll do a pension worksheet that's exactly like the one on the exam. Because remember, the one on the exam doesn't have the gains or losses or the prior service costs. So it's a basic pension worksheet like we've got practice with before. And I apologize for running short on that, guys. Hot dog, are we okay with that? We ran out of time. Time flies when you're having accounting fun, right? All right, guys. Well, I will see you on Monday. Make sure to take a look at that test review and, be prepared. Let me know if you have any questions. You know where to find me, but also we'll go over it together on Monday, okay? All right, guys. Bye-bye. Have a good rest of your day. Have a good weekend. Bye-bye.
Bye.
Bye, guys.